Disclaimer.
Yesterday morning, at exactly 9 a.m. in the quiet, high-security halls of Davos, the silver market as we know it died. Not with breaking news alerts, not with emergency broadcasts. It died in a conference room where the world's financial elite realized they have been backed into a corner they cannot escape. While mainstream media obsesses over political theater, a financial trap has been quietly sprung. For the first time in modern history, the President of the United States has effectively put a gun to the head of our credit system with a proposal to cap interest rates at 10%. If you think silver at $95 per ounce is expensive, you haven't seen the wall of liquidity that's about to flood this market. Here's what's really happening behind the headlines. President Trump's 10% cap isn't just a consumer protection measure. It's a systemic shock to bank profit margins that's triggering something financial experts are calling the credit freeze. Major banking institutions faced a choice following the January 20th deadline: comply with the rate cap and eviscerate their profit models, or simply stop lending to millions of Americans altogether. They chose the second option, and the consequences are already unfolding in real time. By Monday morning, industry analysts warn that 80% of Americans could lose access to their revolving credit, not because of missed payments or bad credit scores, simply because banks have decided the risk-reward equation under the new constraints doesn't work anymore. When your credit card stops working, when that financial safety net millions depend on suddenly vanishes, what becomes the alternative currency for daily survival? Physical metal, real assets you can hold. Silver that exists in your hand, not as a number on a screen. But here's where our story takes an unexpected turn. While credit is being rationed at the retail level, something else is happening in the precious metals market that should grab everyone's attention. Silver, the industrial metal that most people associate with jewelry and photography, has been quietly moved to a very different category. Under the Defense Production Act, silver has been reclassified and added to the National Defense Stockpile list. What does that mean in practical terms? It means the government now has priority over retail investors for physical delivery of silver. You might think you're buying silver as an investment or a hedge, but there's now a legal framework that puts federal procurement ahead of private ownership when it comes to physical metal allocation. The timing is remarkable. This reclassification didn't happen during a declared emergency. It happened quietly, through administrative channels, while most Americans focused on other headlines. And almost nobody in mainstream financial media has connected this policy shift to what's happening in credit markets or to the crisis unfolding across the Pacific. At this exact moment in Tokyo, the Japanese bond market just suffered what financial analysts are calling a 6 standard deviation move. To put that in perspective, this is the statistical equivalent of a magnitude 10 earthquake. Events like this aren't supposed to happen in modern financial markets. They're supposed to be impossible, 1 in a billion occurrences that only exist in theoretical models. But it just happened. Japan's 10-year yield surged to 2.16%, breaking the global carry trade that has underpinned financial markets for over a decade. Here's why this matters to every American watching their savings and investments. Japan is the world's largest creditor nation, holding massive amounts of U.S. Treasury bonds. As their own bond market implodes and the yen collapses, Japanese institutions are being forced to liquidate their dollar-denominated assets. That capital isn't flowing into stocks or back into bonds. It's flooding into physical bullion as the only viable Tier 1 collateral under the new banking regulations. The global carry trade, where investors borrowed yen at near-zero rates to invest in higher-yielding assets around the world, is dead, and it's taking the paper price suppression mechanism in silver down with it. Let me put this in perspective for you. As of today, spot silver is testing $95.89 per ounce. But here's what makes this situation truly extraordinary. The paper market tells a very different story than the physical market, and that divergence is about to become a crisis. On the COMEX exchange, where most silver trading happens, the leverage ratio has reached 356 to 1. For every actual ounce of physical silver that exists in COMEX vaults, there are 356 paper claims on that same ounce. It's like selling the same house to 356 different buyers and hoping they never all show up with moving trucks on the same day. This system has existed for decades, working because most traders settle in cash rather than demanding physical delivery. But when Japanese institutions start liquidating dollar assets into physical metal, when American credit dries up, and people seek tangible alternatives, when the government prioritizes silver for national defense, suddenly everyone shows up wanting the actual metal at the same time. The mathematical probability of a force majeure event, where COMEX simply declares it cannot deliver physical metal and settles all contracts in cash instead, has moved from conspiracy theory to statistical certainty. Financial risk models tracking COMEX default probability are showing readings never seen before in the modern precious metals market. Think about what force majeure settlement means. You bought a contract expecting to receive actual physical silver. You paid based on spot price, you followed all the rules, and then you're told, sorry, we can't deliver the physical silver. Here's cash instead, based on a settlement price we determine. Your paper claim to real metal evaporates into a cash payment that may not reflect the true market value of physical silver at that moment. This is where the credit freeze, the Japanese crisis, and the silver market intersect in ways that create what analysts are calling a shadow currency emergency. When traditional credit becomes unavailable, when paper assets become suspect because of extreme leverage, when foreign creditors liquidate into physical metals, what do sophisticated investors turn to? They turn to tangible assets with intrinsic value, commodities with industrial demand and monetary history. The data coming out of COMEX vaults tells a story that should alarm anyone paying attention. Over 33.4 million ounces were withdrawn from registered vaults in just the last 7 days. That's not normal market activity. That's an exodus of physical metal that suggests major players are taking possession ahead of an anticipated event. What event? Some point to February tariff implementations. Others focus on Basel III banking regulations that fundamentally change how banks must hold precious metals. But the smart money isn't waiting to find out which trigger comes first. They're converting paper claims into physical possession now, while metal can still be obtained at prices that may soon seem remarkably cheap. And here's what very few people understand yet. The premiums on physical silver coins and bars have already diverged from spot prices in ways that reveal extreme supply constraints. American Silver Eagles selling for $15 to $20 over spot isn't just dealer markup. It's a signal that physical metal is genuinely scarce at the retail level, and that scarcity is about to become critical. In this investigation, I'm going to prove why $112.42 per ounce is no longer just a target, but a mathematical certainty before February ends. I will show you how Basel III now strictly forbids banks from continuing their leverage games with paper ounces. And most importantly, I'm revealing the single legal loophole buried in Title 31 United States Code, Section 5, 1112, that could protect your wealth from the 2026 AI-driven tax net that's already scanning every transaction. The window to acquire physical silver under $100 is closing, not in months, not in weeks. The institutional data suggests we have 72 hours before the next liquidity wave hits this market. For everyday Americans watching this unfold, the implications run deeper than silver prices. We're witnessing a fundamental shift in how our financial system operates. When banks ration credit, when paper markets show dangerous leverage, when physical commodities get reclassified for national security, when foreign creditors liquidate into tangible assets, these aren't isolated events. They're symptoms of a system under extraordinary stress. The question isn't whether these changes will affect your financial future. The question is whether you understand what's happening in time to make informed decisions. The silver market is sending signals about broader transformations in our monetary system. And those signals connect directly to the financial realities Americans face every single day. What happens next will determine whether you're positioned on the right side of the greatest wealth transfer in modern financial history. Now let me show you exactly why the paper-silver game is mathematically over. This isn't speculation or conspiracy theory. This is documented evidence from the world's most powerful financial institutions. And the numbers tell a story that Wall Street desperately doesn't want you to understand. Let's start with what happened in Tokyo, because this is where the dominoes began falling in a way that cannot be reversed. On the surface, Japan's 10-year government bond yield jumping to 2.16% might not sound dramatic to most Americans. You might be thinking, 2%? That's nothing compared to our mortgage rates. But you'd be missing the magnitude of what just occurred. In statistical terms, this move represents a 6 standard deviation event. Let me put that in perspective. In a normal distribution, a 3 standard deviation event has a 0.3% chance of happening. A 4 standard deviation event? 0.006%. A 6 standard deviation event is so statistically improbable that it should occur roughly once every 500 million years. It just happened in the Japanese bond market. And it's not a random occurrence. Japan has maintained near zero interest rates for over 3 decades, creating the foundation for what traders call the carry trade. Investors would borrow yen at essentially 0% interest, convert those yen into dollars, and invest in higher yielding assets worldwide. American stocks, emerging market bonds, real estate, commodities. The strategy was simple and extraordinarily profitable. As long as one assumption held, Japanese rates would stay near zero forever. That assumption just died. And the unwinding isn't gentle. It's a forced liquidation on a scale the modern financial system has never experienced. According to the Bank for International Settlements, outstanding carry trade positions peaked at over $20 trillion in dollar equivalent value. When Japanese yields surge and the yen strengthens, every single position becomes a losing trade simultaneously. Investors aren't choosing to exit. They're being forced out by margin calls and risk systems that won't tolerate the losses. Where does that capital go when it exits? This is the critical question that explains everything happening in the silver market right now. Under Basel III banking regulations, which govern how international banks must manage their balance sheets, there's a very specific tier system for what qualifies as high-quality collateral. Stocks don't qualify. Corporate bonds don't qualify. Real estate doesn't qualify. Even government bonds are getting downgraded in terms of their collateral value after what we just witnessed in Japan. Physical gold and physical silver, however, maintain their status as Tier 1 collateral. They are the only assets that central banks and international financial institutions universally accept as the highest quality reserves. When you're a Japanese pension fund or insurance company forced to liquidate $20 billion in dollar-denominated assets, you're not moving back into yen bonds that just proved catastrophically unstable. You're moving into physical bullion. This explains the explosive demand we're seeing in wholesale physical markets. According to the World Gold Council's latest data, central bank gold purchases hit record levels in the fourth quarter of 2025. But here's what's not making headlines. Silver purchases by sovereign entities have increased by 367% year over year in the same period. That's not a typo. Silver demand from governments and central banks has more than quadrupled. Now let's talk about why banks can't continue their paper silver game even if they wanted to. This is where Basel III's net stable funding ratio becomes the death blow. The NSFR requirement, fully lived for the 2026 cycle since January 1st, mandates that banks maintain at least 85% stable funding for their assets. If a bank holds a short position in paper silver, they now need capital reserves equal to 85% of that position's value in stable, long-term funding. HSBC and JP Morgan, the two largest holders of short silver positions on COMEX, according to a commitment of traders' reports, would need to allocate hundreds of millions in capital reserves to maintain existing paper positions. The capital costs money, and it has to be justified to shareholders and regulators. Before Basel III and SFR, banks could hold massive short positions with minimal capital allocation. The cost of suppressing silver prices through paper contracts was negligible compared to the profits from other operations. But now, the cost has become prohibitively expensive. Every ounce of paper silver they sell short without physical backing requires them to lock up capital that could be deployed elsewhere for actual returns. This is why we're seeing the unprecedented divergence between paper and physical prices. The paper market on COMEX still shows silver trading in the mid-90s, but try to actually buy significant quantities of physical metal at that price. The premiums tell the real story. According to dealer networks across the country, American Silver Eagles are commanding premiums of $18 to $22 over spot. Gold-silver ratio calculations, which historically trade around 70 to 1, have compressed to levels suggesting physical silver should be trading above $105 per ounce already. The banks know they can't maintain the paper leverage game under NSFR requirements. The question is whether they'll gradually unwind their positions, or whether they'll wait for a force majeure event that allows them to settle in cash and walk away from physical delivery obligations entirely. And here's your proof that smart money has already made their decision, the vault withdrawal data. COMEX registered vaults have seen an exodus that can only be described as panic-level positioning. Over 33.4 million ounces withdrawn in 7 days. That's 4.2 million ounces per day. At that rate, the entire registered inventory would be depleted in less than 90 days. But it's not just volume, it's who's withdrawing. The major withdrawals correlate with positions held by large commercial traders and foreign banks. These aren't retail investors. These are institutional entities with inside knowledge, moving hundreds of thousands of ounces into private storage. Why would they do this if they believed COMEX would honor delivery? Why pay transport costs, insurance, and storage fees if those vaults were secure? They're taking physical possession because they know when the system breaks, when that 356 to 1 leverage collapses, people holding physical metal will be protected. People holding paper contracts will receive cash settlements at prices 30 or 40% below actual physical market value. Let me show you the timeline that makes this urgent. The February tariff implementations include a 25% tariff on imports from Greenland, which supplies significant global silver production through Canadian processing. Once those tariffs go into effect, the cost basis for physical silver entering the United States jumps immediately. Current wholesale silver at $96 becomes $120 after tariffs. Retail premiums put American Silver Eagles north of $140. The window to acquire physical metal at pre-tariff prices is measured in weeks, possibly days, and that is assuming COMEX can maintain the fiction of 356 to 1 leverage for even that long. The combination of NSFR requirements, forcing banks to reduce paper positions, Japanese carry trade liquidation flooding into physical demand, government stockpiling under the Defense Production Act, and institutional vault withdrawals creates a perfect storm that cannot be sustained. Have you noticed that mainstream financial media isn't covering any of this? CNBC talks about silver as a volatile commodity play. Bloomberg mentions industrial demand for solar panels. Nobody's connecting the dots between Basel III NSFR, the Japanese bond crisis, COMEX leverage ratios, and government stockpiling mandates. That silence is intentional. Because once the average American understands that the paper price is a fiction, that physical metal is disappearing from available inventory, that major banks are withdrawing from the market rather than face NSFR capital requirements, the rush to convert paper wealth into physical assets would overwhelm the system overnight. The proof is in the numbers. The Japanese bond market just told us that trillion-dollar carry trades can unwind in days, not months. Basel III, NSFR just told us that banks can't afford to maintain paper silver shorts without massive capital allocation. COMEX Vault data just told us that insiders are taking physical possession before the general public realizes what's happening. The only question left is whether you're going to act on this information while there's still time, or whether you're going to wait until the force majeure announcement makes it national news and physical silver is already trading at prices that seem impossible from today's perspective. Because once this breaks into mainstream awareness, the 72-hour window I mentioned isn't a dramatic exaggeration. It's the mathematical reality of how fast markets move when 356 paper claims try to become one physical ounce. Now, let me show you the exact mathematics that point to $112.42 as the inevitable target, and why this number is not speculation, but a calculated equilibrium point based on converging policy decisions and market dynamics. Start with the baseline. Silver rallied 230% from its 2025 lows to current levels. That move wasn't random. It was driven by industrial demand, monetary debasement, and the early stages of the credit contraction we're now witnessing accelerate. But here's what most analysts are missing. That 230% rally happened before the February tariff wall goes into effect. President Trump's announced 25% tariff on Greenland imports fundamentally changes the cost structure for physical silver. Greenland supplies significant global silver production through Canadian processing. Once that tariff is implemented, every ounce crossing our border carries an immediate 25% price increase. Current wholesale spot at $96 becomes $120 post-tariff. That's the new baseline, and it's not temporary. It's a permanent cost structure shift. Overlay historical premium patterns during supply constraints. During 2020 and 2021, American Silver Eagles traded at premiums of $18 to $24 over spot. We're already seeing those premiums now, before tariffs, before force majeure recognition, before mainstream awareness. Take post-tariff wholesale at $120, add conservative retail premiums of $15, and you arrive at $135 for American Silver Eagles. But that assumes normal market conditions, which we demonstrably do not have. Factor in the COMEX leverage collapse. When 356 paper claims compete for one physical ounce, premiums don't follow normal patterns. They explode. During the London gold pool collapse in 1968, physical premiums reached 40% over paper prices within weeks. The $112.42 target represents the equilibrium where three forces balance: the 230% rally trajectory, the 25% tariff impact, and current COMEX inventory depletion rates. This isn't a ceiling. This is a waypoint to much higher valuations. But it's the mathematically derived price point where silver trades by the end of the Davos cycle in late February. Now, here's where most people make a catastrophic mistake. They'll see silver hit $112, watch paper profits accumulate, and think they're wealthy. Then they'll try to sell and discover a trap that could consume 50% of their gains. The IRS just activated AI-driven reporting for 2026. This isn't traditional Form 1099-B. This is algorithmic surveillance of every precious metals transaction designed to capture tax revenue from the wealth transfer. Under new rules, any sale of generic silver bars over 1,000 ounces triggers automatic reporting. But the algorithm also flags patterns across multiple transactions. Sell 500 ounces in January and another 500 in February, even below the threshold each time, and the system correlates them and flags your account for audit. Once flagged, you face capital gains tax at ordinary income rates, potentially 37% federal plus state taxes, adding another 13% in places like California. That's a 50% total tax hit, turning $112 silver into effective proceeds of $67 after taxes if you bought at 40. Worse, the IRS audit process now includes basis verification requirements. You must prove what you paid originally. If you bought generic bars with cash years ago without receipts, the IRS assumes zero cost basis. You pay 50% tax on the entire sale price, not just gains. Think about what this means. You could buy silver at $96 today, watch it rally to $112, try to sell your generic bars, and end up netting less than you paid after taxes and penalties because you can't prove your original purchase price to the satisfaction of the AI audit system. This is the trap, and it's designed specifically to capture wealth from Americans who think they're protecting themselves with precious metals, but don't understand the legal framework surrounding how they hold those metals. Now let me reveal the loophole buried in Title 31 of the United States Code, Section 5112, subsection E. American silver eagles are classified as legal tender under federal law. They're not just bullion. They're actual United States currency with a $1 face value. This legal tender status creates a reporting exemption that generic bullion doesn't enjoy. Under current IRS regulations, selling legal tender coins doesn't trigger the same dealer reporting requirements as generic bullion. When you sell American silver eagles, dealers aren't required to file Form 1099-B unless you're selling extraordinarily large quantities that trigger different thresholds related to cash transactions, not precious metals specifically. The legal tender status provides privacy in transactions that generic bars cannot match. When you use American silver eagles in private transactions, you're exchanging legal tender currency, not engaging in a precious metal sale requiring cost-basis documentation and capital gains calculation. I'm not advocating tax evasion. I'm not suggesting you hide assets. What I am telling you is that the legal framework treats American silver eagles differently than generic bullion, and that difference becomes critically important during a monetary crisis. If you hold generic bars and try to sell when silver hits $112, you're entering a tax and reporting framework that could consume half your gains. If you hold American silver eagles and need to access that wealth, you have options that generic bullion holders do not have. Private party sales, legal tender exchanges, and reporting exemptions that are perfectly legal, but create a fundamentally different outcome for your financial preservation. This is why premiums on American silver eagles have diverged so dramatically from generic bars in recent weeks. Sophisticated investors understand the legal tender loophole. They're willing to pay $18 to $22 over spot for eagles, even though they could buy generic bars at much lower premiums, because they know the exit strategy matters as much as the entry point. The wealthy don't just buy assets. They buy assets with legal structures that protect their wealth from confiscation, taxation, and surveillance. American silver eagles provide that structure. Generic bars do not. So here's where we are. Silver is mathematically headed to $112.42 by the end of February, based on tariff implementation, COMEX leverage collapse, and the ongoing credit freeze. That's not a prediction. That's a calculation based on converging policy decisions and market dynamics that are already in motion. When silver reaches that price, you'll face a choice. If you hold generic bullion, you'll navigate a 50% tax trap designed to capture your wealth transfer gains. If you hold American silver eagles, you'll have legal options that preserve significantly more of your wealth through the reporting exemptions and legal tender status. The window to position correctly isn't theoretical. It's measured in days, possibly hours, as institutional players continue withdrawing physical metal from COMEX vaults and the February tariff deadline approaches. Every major financial transition creates winners and losers. The winners are the people who understand the legal framework, the tax implications, and the privacy structures before the crisis becomes obvious. The losers are the people who wake up when silver hits $112, try to capture gains with generic bullion, and discover they're giving half their wealth to a tax system specifically designed to harvest crisis profits from the unprepared. You now know what the insiders know. You understand why $112.42 is the mathematical target. You understand the 50% tax trap waiting for generic bullion sellers. And you understand the legal tender loophole that American silver eagles provide. The question is whether you'll act on this information while you still can, or whether you'll watch this unfold from the sidelines and wish you'd understood the framework before it was too late. If this information just changed how you see your financial future, do me one favor, share this video with someone who needs to hear it. The system counts on Americans not understanding the legal frameworks that protect wealth. Every person who learns this information is one more person who can't be trapped by the system. Hit that share button now.